Hello everyone, we are doing Annuities Part 2 for today, and please don't forget to subscribe, like and share. We're going to get started right here. So annuity, there are different types of annuity. So straight life annuity is an annuity that pays the annuitant during the lifetime, right? Pays guaranteed income for annuitant's lifetime, after which the time payment stop, no residual benefits to beneficiary. So an annuity can be a straight life, which means only pays while that annuitant is alive, right? Also, an annuity can be a per certain annuity, so which means that a guaranteed definite minimum payment are being made to the annuitant, right? It could be for 10 years or 20 years. If you spread it out, you get less annual money. If you put it, you want to get it sooner, you get more. But at the end of the day, the stretched money is going to be better for people, right? Period certain annuity that you get the payment in 10 years, 20 years. So minimum definite number of period of payments. A life with period certain annuity is another option that combines the first one and the second one. That's basically what it is. So if the annuitant is still alive, so and then they still continue, even if that period finish, they still get a lifetime income. But if the person pass away and then the number of payments are not finished, and then the beneficiary gets those payments, designed to pay an annuitant an income for life, but guarantees a definite minimum period of payments. If the annuitant dies during the specified period, benefit payments continue to beneficiary until that period is ended. So it's giving both options. If the person lives, it gives him more money for life, and then if the person pass away, certain number of years are unpaid, and that will be paid to beneficiary. A joint life annuity is a type of a multiple life contract which have more than one annuitant, right? A joint life has more than one annuitant, and that pays, they can be paid at the same time. Benefits will end once one of the annuitant dies. If one of the annuitant dies, that's called first to die, and then that's a joint life annuity. A joint life annuity. A joint life and survivor option. So if it's a joint life and survivor option, so provides a payment for the annuity to two people. If either person dies, the same income payment continues to the survivor for life. When the surviving annuitant dies, no further payment are made to anyone. So last to die. So until both of them die, the payment continues. If you see survivor, it's last to die. If you just see joint only, it's first to die. So other types of annuity include a variable annuity. A variable annuity is the value of the account is invested in a separate account. If you see in the question a separate account, the answer is variable, primarily in a common stock or S&P 500. So variable annuities shift the investment risk from the insurance company to the individual. So the individual is saying, I want my money to be in the market. So the owner is taking the risk, investment risk. So one of the questions is that who is taking investment risk in a variable annuity? So it becomes the policy owner. So one needs a security license to do variable, right? This type of annuity generally consists of two investment accounts, both the general account and then the separate account, right? So that's it. A fixed annuity pays a fixed number of return to the policy owner, right? So fixed annuity provides a guaranteed rate of return and the interest payable given year to declare in advance, right? So it's a fixed number. It could be 3% or 4% or 5% is being credited to the account. Fixed annuity, the investment risk is by the insurance company. So no matter what, if the market performs less, no matter what, they're going to give you that interest rate stated in the policy. Fixed annuity are derived from insurer's general account asset, right? So if you don't see any separate account, it's not variable, right? So fixed annuity, fixed rate of return, right? Another one is an equity index annuity. So it mirrors the market, but it's not in the market. An equity index annuity have a fixed deferred annuity that offers the traditional guaranteed minimum interest rate and then an excess interest feature that's based on the performance of the external equity market index. So it mirrors the market, it's not in the market, so you get the gains of the market, but also there is a minimum guaranteed interest rate. That's called an equity index annuity, right? Other terms to know in an annuity is the principal is the original money that you put into the annuity, right? Through premium. It could be one premium or it could be multiple premium. Tax-free from non-qualified, right? So when you take that money out, it's called return of premium is tax-free. Return of premium is tax-free if it is a non-qualified money that you put in. Exclusion ratio is what we use to calculate, to differentiate taxable from non-taxable, right? It has to be a non-qualified money, a money from a bank. If it is a 401k or a qualified plan, everything is taxable, right? So surrender charge is that, let's say the annuity is going through 10 years or 5 years period of accumulation, but the policy owner is the only person that can surrender an annuity. So if they want to take everything out, there is a surrender charge. Usually the interest credited into the plan might be more than the interest charge. So usually people, if they take it out on the second year and third year, they're going to walk away with more money because the credited amount is better than the surrender charge. But also there is a penalty-free specified percentage, usually about 10% in a year that you can take out with no penalty as well, right? If you want to take everything out, or if you pass the 10%, that's when a surrender charge comes in. 1035 contract exchange happens if you want to move an annuity to another annuity, right? A 1035. Life insurance to another life insurance, right? 1035. So you can do that. Life insurance to an annuity, you can do that, but you cannot do an annuity into life insurance because an annuity is a taxable product, life insurance is not, so you cannot do. An annuity cannot be exchanged for a life insurance policy. So that's the only thing that you cannot do, a 1035 exchange. Move the cash accumulation to another plan is what basically the 1035 exchange. It's deferring taxes, right? So you don't pay in taxes because you are not taking distribution out, you're just moving it, right? 1035 exchange. So a tax sheltered annuity is what you can see, right? A special type of annuity plan that reserves for a non-profit organization and their employees upon retirement. Payment that are received by employee from accumulated saving in a tax sheltered annuity as treated as ordinary income. Everything in an annuity is treated as an ordinary income for tax reasons, right? So now question time, right? Question time. So let's see. What annuity guarantees you cannot outlive the benefits? You cannot outlive the benefits. So accelerated lifetime benefit, B, guaranteed lifetime withdrawal benefit, C, right of income rider. So the correct answer is B, guaranteed lifetime withdrawal benefit. So some of the products that we do for our people, they have a lifetime income, so they are guaranteed not to outlive their benefits, cannot outlive the benefits. So that's one of the good features of an annuity, a guaranteed lifetime withdrawal benefit. Which of the following is an annuity that's linked to a market-related index? So we said that earlier. It's not in the market, but it's mirroring the market. Which of the following is linked to a market-related index? A market-related annuity, a deferred risk annuity, an equity indexed annuity? So the answer is an equity indexed annuity is in a market related index, so it guarantees a minimum of return, but also it gives you, as the market goes up, you also get some gains on the positive, right? Which of the following annuity payout options makes no additional payment regardless of when the annuitant dies? So payout options of an annuity is that if the annuitant dies, what's being paid to beneficiary, right? So that decides. So this is asking, makes no additional payment to the beneficiary regardless of when the annuitant dies. So life only, life with period certain, installment, refund. So the answer is life only. If it's a life only annuity, it only pays during the lifetime of the annuitant. That's it, right? No residual payment to beneficiary, right? No residual payment to beneficiary. So most of the annuities that we do have a death benefit being paid, so it's not life annuity, right? All right. Last questions. What is the non-forfeiture value of an annuity before annuitization? Before annuitization. So before annuitization, it is the accumulation period. So A, all premium paid plus interest. B, all premium paid minus any withdrawals and surrender charge. C, all premium paid plus interest minus any withdrawals and surrender charge. So the correct answer is C, all premium paid plus interest minus any withdrawals. So that's what the beneficiary gets out. It's non-forfeiture, so your money is still there for the beneficiary to receive. Always think premium paid plus interest, but if there is any withdrawals, that has to be subtracted from the death benefit as well. All right, last question. Which annuity payout option allows the policy owner to choose a predetermined number of benefit payments? A predetermined number of benefit payments. A, period certain. B, straight life. C, installment refund. So the answer is A, period certain. So if it's telling you it's predetermined number of payments, so it's exact number of payments, so that's period certain. Period certain will give you for 10 years, it will give you for 20 years of benefits, right? So that's period certain. And that concludes for today. Please don't forget to subscribe, share, and like. Annuity is the weakest link, so people should be spending more time to study annuity so that they can get their license. All right, have a good day.